Welcome back, everyone. And this lesson will be on change in state of delivery and macros. This will be your algorithmic arsenal, meaning this is going to bring a lot of the concepts together, combining time and price. And we're really going to be able to see how the algorithm is operating at specific times of the day off key levels that we're already aware of. And the goal of these lessons, and specifically this lesson in and of itself, is to make the complex simple. We want to trade like the algorithm, but the algorithm is complex. So we need to find ways to internalize what the algorithm is doing in a simple manner. That is the goal of this teaching here. And I'm confident after you start to study some of the concepts that we're going to discuss throughout this teaching, it is going to open your eyes to what is really going on every day in these markets. So what are we going to cover throughout this lesson? Number one, what is change in the state of delivery? 2, macro times. 3, macro signatures. And I'm very, very excited to talk about that. And then 4, high probability inversions in BPRs. And 5, KRP/macro model reinforcement. So all of these things here will really be able to get a good idea of how we can bring all these things together to create a repeatable process over and over and over again. So like I mentioned, we need to make the complex simple. So let's lay a simple, easy to understand foundation before we continue into the advanced concepts. The algorithm has 2 states of delivery. Number 1, Buyside Delivery. Number 2, Sellside Delivery. And there's ways where we can identify if we're in a state of Buyside Delivery or a state of Sellside Delivery. In a buy program, these are some of the things that we want to see. Down close candles supporting price. That would be your bullish order block. Discount PD arrays in general supporting price. So discount fair value gaps, order blocks, bullish breakers, things of that nature. We also want to see bodies respect discount key reference points, because remember, the bodies tell us the story, and those are the algorithmic signatures that we look for. If those are the things that we want to see support price, we want to see up close candles or bearish order blocks fail to act as resistance. So we want to see price smash through bearish order blocks when we're in a state of buy-side delivery. On top of that, we want to see premium PD arrays in general fail to act as resistance. So SIBIs, volume imbalances in a premium, bearish breakers, things of that nature. And lastly, we want to see bodies close above premium key reference points, because think, if we were bearish, we don't want to see bodies close above premium key reference points. But if we're looking at buy-side delivery here, we want to see closures above those premium key reference points to ensure that we are going to continue higher to whatever our target is. And identifying a state of sell-side delivery, we want to look for up-close candles acting as resistance. So that would be your bearish order block. We want to see premium PD arrays act as resistance. So SIBIs, bearish breakers, bearish order blocks, things of that nature. And we want to see bodies respect those premium key reference points. On the opposite end, we want to see down close candles or bullish order blocks fail to act as support. We want to see discount PD arrays in general fail to act as support. And lastly, we want to see bodies close below discount key reference points to ensure that we are going to continue lower when we are bearish. Now we can combine change in the state of delivery with macros. So before we continue and look deeper into change in the state of delivery, let's talk about macros real quick. So I'm sure most of you are aware, but if you are not, a macro is just a time period throughout the day where price is coded to deliver to liquidity or an inefficiency. In other words, during this time period in the day, we're expecting price to move. We're expecting price to do something. Now, the main macro times that we're going to utilize in this lesson and just in our key reference point and macro model in general are the ones you see here. So we have our 20-minute time periods throughout the day. 850 to 910, 950 to 1010, 1050 to 1110, and 1150 to 1210. And that's all Eastern time. So if you see I have that school bus on the right side, think of these macros as bus stops. Think about this is the time of the day, or in other words, the schedule, where the algorithm's going to stop and deliver to a key reference point. It's coming down to a key reference point, and then it's going to reverse and give us our lower time frame model. That is the thinking behind this model and the way we read price. Having these macro times alone helps us get rid of so much of the guesswork outside of these times. Now, there will be times where, of course, we'll enter before or after these macros, but the main framework for the model in general is what is occurring during these macro times, during these 20-minute scheduled periods where the algorithm is coded to spool to liquidity or inefficiency. So what do we want to see during a macro? We want to see time meet price. In other words, we want to see a key reference point be delivered to during a macro. So this is why ICT always says the algorithm refers to time and price. Seeing what key reference point it's working at this specific time of the day is literally showing us what the algorithm is operating on in terms of a price point and when it is doing it. After those two things occur, all we're waiting for is our lower time frame model, our lower time frame entry. But the foundation of all of this is the key reference point and the macro. Having those two things as our foundation of our trading, of the way we engage with price, helps us get rid of so much of the noise, so much of the guesswork outside of when we're not in a macro or price hasn't delivered to a key reference point. We simply don't take the trade. We're waiting for the high probability setups when we see the algorithm working this key reference point during a macro. Now, for the rest of the lesson, we're going to look at macro signatures and see how we can combine some of these concepts to understand what the algorithm is doing, to understand when we should enter our trades. So number one, we have macro change in the state of delivery. That's what CISD stands for, of course. Then we have macro SMTs. Number three, we have delivery to a key reference point. Number four, we have a macro inversion. And number five, we have a macro BPR. And these signatures are super, super powerful once you can start to identify them in price action. So let's start with macro change in the state of delivery. Looking at this chart, the first emphasis is on time. What time of day is it? 1050 macro. And what occurs once we are in this 1050 macro? We have a change in the state of delivery. That occurs right here once we get over this down close candle. That's your bullish order block. When we start to wick down into this order block and see support, that's your change in the state of delivery. On top of that, we're wicking into this discount volume imbalance. So there are two things that are starting to occur there to show us that we can expect a move to buy side. But the most important thing is that this is occurring during a macro. Now, in terms of an entry, the aggressive entry, of course, would be on the order block or the volume imbalance, but 99% of my entries are this right here. What is occurring there? This SIBI was initially utilized very shortly, but initially utilized to send us lower. After that occurred, we had the change in the state of delivery, and then right here, the body closes back above it. We should not do that if we're bearish. That's further confirmation on top of the change in the state of delivery we discussed down here. Further confirmation that we should favor buy side to this liquidity pool right here. Okay. On top of that, of course, we have a discount volume imbalance here, but the emphasis is on the closure of this body. The close above that SIBI, this becomes an inversion. That's your change in the state of delivery, because the initial state of delivery from this move down was Sellside Delivery. This SIBI was acting as resistance, pushing price down. The change in the state of delivery comes when we start to see down close candles, discount PD arrays, support price, as well as premium PD arrays start to fail to act as resistance. But the change in the state of delivery is more significant because it's occurring during this 1050 macro. Now let's look at one more example of change in the state of delivery during a macro. So here we're looking at the 950 macro, and this light dashed red line, if you look on the right side of the screen, that is mean threshold of an hourly order block. Or in other words, it's a key reference point during a macro. This is the model, okay? Those two things on top of the change in the state of delivery we're seeing here, that's exactly what we want to see occur if we're looking for longs like we are in this example. So we see that key reference point get tapped during the 950 macro. Think about that analogy we discussed earlier. That's your bus stop. At this scheduled time of the day, it's coming down to this key reference point. Then all we're waiting for is the turning point, change in the state of delivery. We get above this down close candle, that's your bullish order block, into this bullish order block. That's an immediate rebalance as well, okay? That's the initial change in the state of delivery. The next change in the state of delivery is this bearish order block right here, these consecutive up close candles. We use that to push price lower to this key reference point before. Once we close above that on this candle here, that's the change in the state of delivery. All right, so after you start to see these things occur, you just look for whatever model makes sense to you. You could enter aggressively on this order block. You could enter once we close above this bearish order block, right? You could enter on this fair value gap here. Whatever makes sense to you and whatever you can frame your risk on. And then obviously we continue higher, and another change in the state of delivery. This is what we would want to see. We reach this SIBI, and what does the body tell us here? Is it telling us that it's respecting it in terms of resistance and wants to go lower? No, it's closing above it, and it's becoming an inversion fair value gap that we would expect to support price higher. And this would of course be our target, these relative equal highs, which we did end up getting in the afternoon. I just couldn't fit it here on this chart just for visual purposes. But again, the main thing is change in the state of delivery during a macro. Now let's move on to our next macro signature. And this is going to be the macro SMT. So let's start over here, and we're looking at a 1 minute chart of NASDAQ. So we have an SMT between NASDAQ and ES. So NASDAQ is failing to make this lower low, while ES did in fact go purge that low. That's your Kraken correlation. But why would we long NASDAQ instead of ES? Because NASDAQ is the stronger of the two between itself and ES, because it's failing to make that lower low. So we're trusting NASDAQ as the stronger indice. And this is a significant SMT because why? It's occurring during that macro. This is when we can really start to see turning points. This whole move down, we were in a state of Sellside delivery, but the Kraken correlation gives us the initial clues that we can be reversing and going higher. Now, that was the 850 macro. We got that initial SMT. Let's fast forward to the 950 macro and see what was occurring. We drop back down, right? 930 open, push higher, come back down to these relative equal lows. But the SMT lows, do they get swept? No. That's what you want to see if you're looking for higher prices, okay? We come down to purge these relative equal lows. During the macro, what occurs? We have another SMT. So this is gross price action here, but we expand higher, and then what occurs right here? This is another Kraken correlation where ES made a lower low comparison to this swing low, while NASDAQ failed to again. So on top of what occurred during the 850 macro, NASDAQ is telling you again that it doesn't want to go down there. So more reason for us to favor longs in NASDAQ opposed to ES. And finally, what is this right here? That's your change in the state of delivery, which we discussed in the previous slides. We have this SIBI, right? That was respected as resistance, but then the body closes above it. That's your confirmation on top of the SMTs, on top of the fact that it's a 950 macro, and we should expect some of these signatures to come to fruition. This closure above, because the bodies tell the story, is what we want to see. Closure above premium PD arrays, in this case, a form of a SIBI, becoming an inversion when we're bullish. But now we're looking at the same chart, and we see that we had a delivery to a key reference point during this macro. So again, you can see that we actually delivered to it a couple minutes before. This is still fine if we deliver to it and then get the SMT, fail to purge it, right? This is still permissible. But we're seeing time aligned with price. NASDAQ is working one of those key reference points. In this case, it's the 75% level of a 4-hour fair value gap. So it's coming down, tapping it, and then running away real quick. Then we get that Kraken correlation, the SMT. Does the key reference point swing low, get purged? No. That's what you want to see, along with the fact that it's an SMT. So we already had enough to look for entries before when we were just discussing the SMTs here and the SMT in the 950 macro. Now we see that it worked a key reference point as well. So this is a super, super high probability play to at least this buy-side liquidity pool up here. Now let's really hammer this model in. Think about the bus stop analogy. What is occurring here? This is a 1-minute chart of ES, and we see that during the 850 macro, we're running into a key reference point. 4-hour bullish order block close. We tap that level, change in state delivery right here, and then of course we return to it right here again. But this is your bullish breaker, low, high, lower, low. These consecutive up close candles. We have 850 macro, key reference point, change in the state delivery. And then we expand to a logical liquidity pool, right? Equal highs, which was also London highs. And side note, I love when they do that. When it's a session high, but it's also equal or relatively equal highs. And of course, we see after we tap this key reference point and have the change in the state delivery, we get above this breaker. Bodies respect it beautifully, right? Breakaway gap here. And we'll talk about breakaway gaps in the next lesson. And then we expand higher. So we see time meeting price. Macro, key reference point, change in the state of delivery. And again, we see these things occurring over and over and over again. So let's look at another example of the KRP macro model working beautifully. 950 macro. This is your bus stop. We come down to CE, or 50% of a 4-hour wick. Exactly, precisely, to the tick, we're tapping that level. And then what occurs after we tap that level during the macro? We start to have your change in the state of delivery. This bullish order block right here. It's the first sign that a down close candle is supporting price. This whole move down close candles were not supporting price. But after we touch a key reference point during a macro, we start to see that occur. That's significant. On top of that, just a little side signature, Sellside Delivery, Buyside Delivery, BPR. Reasonable to expect price not to deliver down there. Still permissible, but reasonable to expect it not to. And then again, our final change in the state of delivery is this closure on this body here. We close above this SIBI, which is of course a premium PD array. That's a change in the state of delivery. If we were bearish, we shouldn't be doing that with premium PD arrays, but we are. After we tapped a key reference point during a macro and had change in the state of delivery. And then of course, we expand to opening range high. That's a session high that we want to be targeting. And again, these things happen all of the time. What do we see here? Our bus stop. 1-hour bullish order block opening price. We're tapping it to the tick here during a macro. That's your bus stop. Then what occurs? Low, high, lower, low, bullish breaker, and closure right here on this candle above this SIBI. That's your change in the state of delivery. On top of that, this SIBI becoming an inversion, that's a high probability inversion. Why? Now think about this, and I'll have examples of this in following slides. The algorithm initially utilized this SIBI to send us to our key reference point. Once we close back above that SIBI, that's a high probability inversion, as well as our change in the state of delivery. And then the rest of the trade in terms of targeting is your preference. You can scalp it here and take it all off, or you can take a partial there. You can hold partials for what was here, previous day AM session high, so a session high, right? And then previous day high, that could be your terminus. So this logic repeats over and over and over again. Now with the macro inversion, we're going right back to that example from earlier, where we had the SMT initially, and then we had the key reference point, another SMT here, and this inversion. All of these things are occurring. These are all the macro signatures that you want to look for if you're seeking longs. So let's look at another way to internalize and use macro inversions. Now, this example, it isn't going to be for a giant move. That's not the purpose of this example here. It's just to reinforce the logic behind what is occurring. Okay. We need to start over here in the top left at the 1050 macro. We leave equal highs or engineered buy side liquidity. And then we have this SIBI formed. So this SIBI was utilized by the algorithm initially to send us lower to our key reference point, which is our 4-hour bullish order block opening price. So that was the initial state of delivery. That was initially what this fair value gap was utilized for. The change in the state of delivery here is this closure above that SIBI, making it an inversion. That is your high probability inversion. And that's when you start to get signatures and would say, okay, I don't want to see a close back below this inversion. The wick is permissible, but the bodies need to respect the inversion. Okay. Obviously, even if you did enter at this closure above, you would get a continuation move, right? That's not the emphasis, like I said, though, for this. In this case, you would have had your key reference point after a stop rate, 1150 macro, right? You could enter there. Change in the state of delivery is when we start to close above these SIBIs and we start to see support from this BISI here, okay? But the emphasis here is on the fact that this SIBI was created during that 1050 macro and sent us lower initially. Then we just wait for the body close above. And here we have another example of a macro inversion signature. So we have the 1150 macro we're looking at that sends us down to this hourly rejection block. This SIBI was utilized. It was the tool. It was the inefficiency that the algorithm used to send us to the key reference point, right? Like we mentioned in the previous slides, once we get that close above right here, that's the change in the state of delivery, making this a high probability inversion. And we expect this to support price. And as we see here, we don't even return to 50% of the inversion. That's the signature that you want to see to confirm that you're on side, all right? Side note as well, this kind of down and up formation, V-shaped recovery, some people call it, that's your trap short formation. So on top of the fact that we know that we ran these equal lows into a key reference point during a macro, we know that if these are trap shorts, sell-side delivery and buy-side delivery, that should be balanced. If these are trap shorts, the algorithm isn't going to want to come back down here to this low to give those trap shorts the opportunity to get out. They're underwater this whole move up. Okay, so everything that occurs right here in this little fractal of price action on the 1 minute chart is telling us that it's reasonable for us to expect longs. Now, we would target buy-side liquidity as our terminus, and as you can see here, we got this at the end of the New York session. Of course, I couldn't fit the whole chart inside of what you're seeing here. It would have been too unorganized, too messy. You wouldn't have been able to read everything I have labeled here. But that would be your terminus, okay? We would take a partial at this SIBI in a premium, right? And it's a little more important too because this buy side and sell side delivery, that is that same balanced price range. But since we're bullish, we want to see us dig above that. So just in case, right, it's a good idea to take partials in price delivery like this, especially since this occurred during a previous macro. And another way to use macro inversions, right here, we look at the 850 macro and how this BISI was formed within that 850 macro. Then we have 930 open and price closes back below it. So the fact that this inefficiency was made during the macro makes it more significant. And then we have the change in the state of delivery once we close below it here. And look at the bodies respect midpoint of this inversion. Now, if you were to enter on this inversion short, your stop loss would have been above this swing high. Obviously, you almost got stopped out. But focus on the logic behind what occurred here. This BISI was formed during the 850 macro, change in the state of delivery when we close below it. You can get short there and target last Thursday's low, which of course is just our session low that's in our closest proximity to our entry. Okay. And here we have our macro balance price range. So if I see a macro BPR, I prefer those and look at them as more significant than a macro inversion. I'll still utilize them with the same logic, but I like the macro BPR because we have buy side delivery, sell side delivery, then we reclaim it. That's a BPR, right? There should be no reason for price to go back down there. Okay. And when we get macro BPRs, that's when I really want to see those signatures where it fails to get to CE, or if it does get to CE, it taps it and then gets going real quick. Okay. But it's the fact that this BPR is getting flipped during a macro. And let's combine some of these concepts to wrap it up. Okay. So look at this clock down here. That's 150 to 210. That's also a macro. Okay. During that macro, we're coming up into this SIBI once, twice, and the algorithm saying, nope, you're not going through there, and sends us down to where? Some random level? Nope, a key reference point. So it's hitting mean threshold of a 4-hour bullish order block. After we tapped that key reference point, following the macro, what occurred? Did we spend a whole lot of time down here? No, we tapped it, and then we have what? Our change in state of delivery here. We continue higher, and then boom. What occurs right here on this candle close? Another change in the state of delivery. What occurs right here on this candle close? Another change in the state of delivery. So these two areas I have labeled high probability inversion. They're high probability because, like we mentioned earlier, the algorithm initially utilized this SIBI to send us to the key reference point. Once that gets flipped, that's high probability inversion. Same thing with this. And this says high probability inversion, but it's really a balanced price range. So this is really strong in and of itself. So if you miss entries down here, once we close above this BPR right here, high probability BPR, that should say, look, Buyside Delivery, Sellside Delivery, then we reclaim it again. On top of everything we saw here with this key reference point and the initial change in the state of delivery off this order block. This can be an entry. We shouldn't expect price to go back below there on a closing basis after we close back above it. So we can start to see a lot of these macro signatures, macros in general, key reference points start to come together to give us really, really, really high probability setups. Okay, guys, I hope everyone enjoyed this video. And our next lesson will be on breakaway gaps and how to anticipate them and utilize them in our trading. If you want to join our free Discord and/or our private community, check the link in the description and you can find that invite link. I'll talk to you guys soon.